William, coming back to the Fed, though, while it's been, pretty much on course of a 25 bips cut that one has seen, but what did you make of the commentary? The fact that they are very much stating in as many words that this is the last of the rate cut that you're going to see this calendar year because of, the US government shutdown and the kind of pressures that it brings about on the economy.
I think what you saw in the Federal Reserve press conference was that Chair Powell was trying to, again, toe the line with a bunch of a very divergent FOMC, the Federal Open Market Committee. You have a large number of members, probably about 7 or so, who want to keep rates exactly where they are, or perhaps even raise rates. And you have others that are trying to lower rates. And I think that tension has gotten greater now that the data has been cut off. And as you said, we're flying blind, we're driving blind in a deep fog. And the optimal thing under uncertainty when you have like that is to slow down. And even that he didn't want to commit to because the data could come online again. And also, it wasn't clear how much tension there was at the FOMC meeting. You saw the vestiges of the extremes with the St. Louis Kansas City Fed president voting for wanting to increase rates, and Mr. Myron wanting to lower rates by even larger amount of 50 basis points. That extreme, I think, reflects the growing tension within the committee, and Chair Powell's got a tough job to try to come to a consensus.
And what next, therefore, William? You'll start to see liquidity conditions likely ease, and this is at a time when equity markets are at their all-time highs. Pretty much all asset classes have rallied. So give us a sense on what that means for asset classes as well as for equity markets in particular.
That's a great point. In fact, I think what you heard that was most important that's been underreported was that the Chair Powell said that we will likely end the quantitative tightening and start to at least allow the runoff of the balance sheet to acquire more treasuries rather than allowing the balance sheet to continue to shrink. That is telling you that the Federal Reserve is getting more and more concerned about the tightness in the short-term credit markets, the repo markets, as it were, and he wanted to have more liquidity put in there, and ending quantitative tightening or possibly even engaging in quantitative easing might be the next step in terms of allowing the Federal Reserve balance sheet to grow, say, at the same speed of GDP, so that the ratio of the balance sheet to GDP stays about unchanged. That is the target I think the Fed is going for. That is another form of easing. So in that way, instead of lowering interest rates, the financial market and financial conditions could be eased through the balance sheet. And that's something that will help stimulate lending and stimulate at least the markets themselves. Now, as far as the stock market is concerned, a lot of concern has been expressed that there's been overvaluation, especially in the AI sector. Chair Powell made it very clear that he felt that a lot of the growth underlying the U.S. economy was coming from the investments in AI. He didn't say that was wrong. In fact, he even said we're looking for productivity changes, and businesses are having to decide whether AI will be allowing them to improve productivity or not. That's something the Federal Reserve is not going to make judgment on, but he's trying to say we will take advantage of that increased productivity because that's the disinflationary force that will calm the inflationary fears and allow us to continue easing monetary conditions to allow the labor market to come back stronger.
Right. Okay, William, thank you so much for all that perspective. Great to have you on the show as always.